The Nasdaq hits 20,000 points as the tech rally rolls on, but can it last? Welcome to Market Insight. I'm Elena Casas. On Wednesday, the Nasdaq closed at over 20,000 points for the first time, up more than 33% on the year as hype over artificial intelligence reached fever pitch. The rally has rewarded investors who went big on growth, but also stirred some unease over just how stretched valuations are. Well, for more, I'm joined now by Keith Gangl, Portfolio Manager at Gradient Investments. Keith, hi. You said in your notes the easier trade for 2025 is higher. Why?
Yeah, the fundamentals are in place. I mean, unemployment here in the U.S. is very low. It's at 4.2%. So again, when consumers are working in the U.S., they love to spend money. That's a key driver for the overall economy. Another key factor we look at is earnings per share growth rate. Next year's forecast is for 15%. This year, we're going to do about 9-10%. Anytime you get in that double digits, that's fantastic. So if we do 15%, that's a key backdrop. GDP growth rate is another thing we look at. And GDP growth rate in the U.S. is right around almost 3% this year. The forecast for next year is a slight slowdown, but 2.7%. So if we do 2.7%, we have unemployment stays relatively low. We think that could tick up a little bit. Earnings at 15% forecast, we think that's a little too high. But even if that stays at 10%, we think that's a good backdrop for the overall stock market.
As you mentioned, though, some of these valuations are pretty stretched. Do you think earnings will justify them next year?
We do. Valuation's high. So if you look at the overall multiple on the S&P 500, we're trading at around 22 times. If you look at the last 5 to 10 years, it's 18 times on a 10-year average and 19 times on a 5-year average. So again, we're at 22 times. So markets are expensive, but valuation is not a sole reason to sell stock markets down. It's a kind of a flashing yellow light for us. But again, with earnings so strong, if they do 15%, that'll make the valuation come down. And we're expecting kind of that normalized year. Last year we were up almost 25% in the S&P 500. This year, currently, we're at about 28%. So fundamentals are in place for that more of a positive normalized year. And normalized year is about that 8 to 10%. So we think that's possible.
Should investors be looking to move some money, especially out of growth stocks, though, in case of a bubble bursting?
Yeah, we think the market is starting to broaden, which is a good thing. If you look at the last 18 months, last 2 years, the performance has been driven by the Magnificent Seven. We think other companies' fundamentals are starting to finally turn around. You're starting to see some earnings acceleration. Now, the earnings have been fantastic for those Mag 7 companies. Their growth rates are 20% plus. We think that number is going to start going down. That 20% starts going on to 15%. Whereas if you look at the rest of the market, the earnings growth rates were, sub 5%. And that's going to accelerate from that sub 5%, go to 5 to 10, maybe even plus. So the earnings growth rate's actually accelerating there on for those companies. So that's something we're interested in, the broadening out of the market.
Do you think that concentration in the Mag 7 looks unsustainable if the market doesn't broaden out soon?
Yeah, the markets, those Mag 7s make up about 32% of the overall S&P 500. That's at historical highs, so we do like to see it broaden out. But that doesn't mean necessarily those are going to be bad stocks. We just think the rest of the stocks can play, catch up and outperform those Mag 7. By them doing that, that number could, go down to 30% to, 28, that type of thing. That's where we're in that range we're a little more comfortable with. So we are starting to, take some of our winners down a little bit on those Magnificent Seven and starting to buy the rest of the market.
Let's talk briefly about the Fed, Keith. Markets see a cut next week as baked in, but could a more hawkish position with fewer cuts next year slow some of that stock momentum?
That could certainly do that. I mean, investors are expecting a cut. We're up to about 98% probability of a cut next week, so looks pretty certain that the Fed won't surprise us. The biggest thing is what they'll guide for next year. Right now, the consensus probability is for around anywhere between 3 and 4 cuts. So that's about 100 more basis points next year. Now, if inflation stays a little bit sticky, maybe the economy actually starts heating up again, maybe they won't cut as much, and that could be a slight headwind for the overall market. But I'm actually more of a favor if the economy is really strong, have less Fed cuts, and I think that would actually drive the market higher anyway. So again, those are something we have to watch. But investors are looking for those cuts next year, and that could be a slight surprise if we don't see 3 or 4 cuts next year.
Keith Gangl of Gradient Investments, thank you so much. Well, that's your market insight. Don't forget to watch more videos on Reuters.com.